The stock market continues to fall even after we got some great earnings reports from the four large tech giants yesterday. We saw the largest tech companies in the world and on the stock market beat on both revenue and earnings expectations, but it still wasn't good enough to please the market. We are still seeing more red today as the Dow has dropped over 100 points to start the trading day, even though we saw these massive companies post better than expected earnings reports. So in this video today, we're going to go over Google, Amazon, Apple, and Facebook, the big techs who all reported their earnings after market close yesterday, go over what they reported and how their stock price has been influenced since the report. And we're going to take a look at the decline we've seen in the share prices over the past month, even though these companies are reporting strong operations. The pandemic continues to grow, the nerves regarding the election, there's a lot of volatility in the market right now, and regardless of strong earning reports from some of the largest and most recognized brands across the globe, we are still seeing a pullback in the market, and as of right now, we don't know what's going to please it and what's going to make it go back up into the green. So every single day on this channel, we talk about the stock market. I am the Gen Z investor, and we talk about different stocks you can buy and sell within a portfolio. And in this video, we're going to focus on the crushed earnings reports we just received from the major tech firms yesterday night. And as always, please hit that like button and subscribe. I'm going to jump right into the first stock, which is Google. Alphabet, the parent company to Google, saw a huge earnings report absolutely crushing revenue and earning expectations. And Google is the only stock of the major four that has actually seen an increase related to the earnings report. Shares are up over 5.4% today, a massive bump up from this latest result. And this company saw a huge report, and in after hours trading before market open today, shares actually peaked up over 10%. So if we take a look at the report, they had a very strong third quarter, rebounding after they had a very tough Q2 in 2020. So in Q3, they reported earnings per share of $16.40 compared to $11.29 were the analyst expectations. So they absolutely crushed earnings per share guidance. And if we take a look at revenue, they brought in $46.17 billion compared to the expectation of $42.9 billion. So over a $3.5 billion beat for revenue. Their cloud expanded very nicely. YouTube ads saw a great growth, beating by close to $1 billion over the expectations, and traffic acquisition costs were up as well. So YouTube and Google saw a huge quarter. The company beat on every single metric, and we can take a look at some charts. They saw 9.8% Q3 year-over-year growth, and total ad spend and total ad revenue on Google saw another increase, and if we take a look at last year's same quarter, you can see here a nice bump up to where we are today. So Google beat on every single metric, a very, very strong quarter, and the ad spend, which saw a huge decline in Q2, all came back and actually exceeded, far higher exceeded analyst expectations. So overall, this company put a great quarter. And moving into the holiday season, when companies are trying to build back what they lost in earlier quarters, we can expect a strong fourth quarter to finish off the year as Google and hopefully ad spend continues to ramp up. One thing that's great to see from Google is their subscription-based services are growing as well. They have over 30 million music and premium paid subscribers. They also have over 3 million YouTube TV subscribers as well. In the world of subscription-based services, which are growing in demand rapidly day over day, month over month, quarter over quarter, it's great to see that YouTube is contributing to that success and is continuing to expand into that subscription-based model, and they're doing a nice job of just that. The second major tech firm was Amazon, and they reported sales growth of 37%, absolutely killing analyst expectations. But that still wasn't good enough to please the market, as Amazon shares are down 3.7% today during the trading day. So we've seen a decrease even after they posted a very strong quarter, and moving into Q4, the holiday season, I believe they're going to even post another record-breaking quarter to close out 2020. So if we take a look at their report, they brought in $12.37 earnings per share compared to analyst expectation of $7.41. That is a massive, massive beat on earnings per share, but the stock still sees a decline. They have revenue of $96.15 billion, beating the expectation set at $92.7 billion. So once again, a huge beat on revenue, but still not good enough to please analysts and investors. If we take a look, they said for the fourth quarter of 2020, they're expecting between $112 billion and $121 billion in sales. So they gave us a nice range, which works out to an average around 30 to 35% year-over-year growth, another absolutely insane growth rate. And analysts were expecting for Q4 $112.3 billion. So in Amazon's guidance, they set the low bar for their revenue expectation right at the mark of analysts' expectations right now. So currently, they're projecting to beat analyst expectations into the fourth quarter of 2020, and we will see if they can do just that. But I believe with retail stores being shut down over the holiday season, there's no way people are going to be crammed into stores, filling up lines out the door. I don't think that's going to happen this holiday season, and I believe Amazon is going to see a record-breaking quarter, and they could even surpass that top line expectation they set out for themselves. One of the reasons why the stock may be down is that Amazon announced that they're expecting $4 billion costs regarding the pandemic. $4 billion of costs regarding to how they're going to maintain operations throughout this pandemic, and that kind of hits investor sentiment. That may be the one negative we got from this report that I personally believe is not that big of a deal. We're going through a global pandemic, and analysts still saw 37% growth. So even though we're going through a worldwide pandemic that is shutting down businesses all across the globe, Amazon is still seeing record-breaking growth rates, and just because they announced a $4 billion expense related to the pandemic, investors are scared. This company brings in massive revenue, they bring in tons of net income, and a one-time $4 billion expense I don't believe is enough to drag down the share price of this e-commerce giant. Although the $4 billion does really hurt their bottom line, they house over hundreds and hundreds of thousands of employees, and they have to keep them safe. So I have no problem with them spending this amount of money because this will not be a recurring expense. Once the pandemic is over, these costs go away. Once they put the upfront money into building these safety procedures, guidelines, and any other safety aspects they have to add to their facilities, once they're up, they're already there. These are a one-time cost. It's not like Amazon added a $4 billion recurring expense year over year. So I have no issues with this $4 billion expense, which may be the reason we see the share price down over 4% today. The next major tech firm is Apple. So Apple, although they saw a decline in iPhone revenue, beat on total revenue and total earnings expectations as well. And shares are still down close to 5% today. So there's nothing these big tech firms can do to please investors and get the share price bouncing back up. We're seeing, and these are not 1 to 2% declines in share price. We're seeing some significant declines of over 4 or 5% in single day trading. Currently, we're still going through today's trading session, and Apple is down 5.5%. If we take a look at their report, they brought in earnings per share of 73 cents, revenue of $64.7 billion, topping analyst expectations of $63.7 billion, so they beat by $1 billion of total revenue. They beat by 3 cents earnings per share. And if we take a look at all their other sources of revenue, once it gets broken down, iPhone revenue missed by about $1.5 billion compared to expectations and was down 20% year over year. But that shouldn't be too worrying. The iPhone 12 came out now. It's going to be reported in Q4 2020, the newest iPhone. So it's kind of expected that in Q3, people weren't ready to upgrade. Anyone who's looking for the newest, greatest iPhone was going to wait a month into Q4 when the iPhone 12 came out. A lot of promotions regarding new upgrades are going to come out now as the new phone's out. So I really don't think people are making too much, I really believe people are making too much out of this. The fact that they missed by about $1.5 billion on iPhone revenue, although it's a big 20% decline year over year, the newest iPhone comes out Q4 2020. So it kind of makes psychological sense. Why would people want to spend the money to upgrade 1 or 2 months before the newest and greatest phone comes out, where the same model might go down in price because there's a newer model on the market? So I believe this little bit of a decline in iPhone revenue is more of a short-term quarter perspective, because Q4 2020, I believe that's going to rebound very nicely. We're already getting reports that huge pre-order numbers for the iPhone 12 are being fulfilled, and I believe this service and this phone may be another kickstart for Apple and kind of get that iPhone revenue back on an upward trend. If we take a look at their services, This is the real growth for Apple moving forward. This is the key part of their business that's really going to drive demand and share price growth over the long term. So they brought in $14.55 billion of service revenue compared to estimates of around $14 billion, which is a 16% year-over-year increase. These services, like I mentioned with Google and YouTube, the subscription-based models are growing in massive demand, and these are the services and the businesses that you need to grow if you want to stay relevant as a large tech firm. Their other product revenue was up over 20%, once again beating analyst expectations. MacBook revenue was up, iPad revenue beat expectations, and gross margin was slightly higher than expected as well. So they beat on everything. The only one negative for Apple was that they slightly missed on iPhone revenue by $1.5 billion. Every other metric they beat, and although they did see that one decline, it makes sense to why iPhone revenue would be down this quarter, because we're getting the newest, greatest new iPhone coming out right now in Q4 of 2020. The final major tech stock we have to take a look at is Facebook. So this tech giant did report a slight decline in users in North America, but overall they continue to beat analyst expectations and beat on total revenue and earnings per share. But if we take a look at the stock, they are down over 5% today as well. These major tech firms really can't do much to please investors because even though they beat on analyst expectations by a significant amount, I have to say, they are still seeing huge declines. Facebook is down 5.5% today. If we take a look at what they reported, they brought in $2.71 earnings per share compared to $1.91 forecasted by investors. So a beat on earnings per share by a significant amount, $21.47 billion in total revenue, once again beating an analyst expectation at around $19.8 billion. They had 1.82 billion daily active users, which is absolutely insane. 1.8 billion. The population of the world sits at over 7 billion. And they had daily active users sitting at 1.8 billion. That is the kind of control Facebook has over the marketplace. That is huge numbers to see. Monthly active users, 2.74 billion. Once again, beating the expectation of 2.7. And just put that in perspective, every month, 2.74 billion people use a Facebook product or service. And then once again, there's over 7 billion people in the world. So a significant portion of the population uses a Facebook product every single month. And average revenue per user was up $7.89. So overall, these tech firms beat on everything. Facebook saw the ad revenue come back. Same as Google, the ad revenue wasn't hit as hard as people were expecting, and they actually saw some growth in user ads. And that's hopefully because small businesses, medium-sized businesses, and even the large corporations are learning that they have to fight back against the pandemic to try to gain back some lost sales, and advertising may be the way to do just that. So the stock market continues to decline. We're seeing huge drops in some of the major tech firms. All the large companies who reported earnings yesterday, even though they beat by huge numbers, are seeing a decline. Google is the lone tech firm to actually be up today after they absolutely crushed analyst expectations. So those were the major tech firms and their latest earnings report. Thank you for watching, and I will see you in tomorrow's video.